couple of minutes. We won't be too long now, folks. We'll start off in about a minute's time. We'll start in about a minute's time for those of you who are just joining. All righty, well, I think we've got 1 minute to go. There we go. We better not start early, eh, Andrew? We'll get into trouble.
Exactly.
I think we'll give people about 1 more minute to join because it's just turned 12 o'clock now. Won't be long now, folks. We'll just wait until it, just another 30 seconds and then we'll be good to go. I'm going to have my final sip of coffee. All right, well, let's get going. Hi, folks. I'm Sam from Simplicity, and the good-looking one there is Andrew, who's our Chief Investment Officer.
Good afternoon, everyone.
G'day. This is the first presentation actually since our 5th birthday, so we're just going to go over a few things about now we are 5 and just give you a few numbers. And then we'll start talking about the financial markets generally. And I thought particularly what we would focus on, and some people have suggested that we talk about the bond market, the fixed interest market, because obviously with inflation, interest rates going up, what does that mean? And what does it mean for investing in that asset class, but also what does it mean for the general economy? And then as per usual, we'll sort of open it up for lots and lots of questions. You can ask as many as you want to, and we tend to do a sort of a last person standing on the questions. We'll just carry on answering them as long as they come in, and then that's what we'll do. So please do not feel at all embarrassed about leaving early, or if you get into question time and you've got to go and do something else, by all means just leave and we'll just keep on answering questions. So thanks very much for joining. I thought I would share just a few numbers with you now that we are 5 years old. And I'll just let me get up to the screen here. And we started Simplicity 5 years ago. In fact, my partner Amanda, I think, will be sitting at the kitchen table right now where it all started. And 5 years on, here's where we're at. So we have almost over 74,000 members now, getting towards 75,000 members. We're saving them an average of $393 each in fees a year, and that adds up to a lot of money. It's about over $29 million a year now in fee savings versus the average Kiwisaver scheme. Of course, with some of them, we'll be saving a lot more than that. As you may know, we give 15% of our fees to the Simplicity Charitable Trust, who are our ultimate owners. We are ultimately owned by a charity. And so far in the first 5 years, we've given $2.8 million to that charity, and that's increasing at about $150,000 a month now, and very focused on charities that we ask you about. So you members consistently tell us that the areas that they would like us to focus on in terms of charitable giving are the homeless, children in need, and environmental causes, and also financial literacy, so teaching people about money. So we're just absolutely delighted to have got to that point. And as you can see there, we're managing almost $3.9 billion of New Zealanders' money. And that sounds like a lot, but that's still, that's only, it's around about 2% of all of the money that we could be managing. So we have a long way to go. So even though we've been running for 5 years, we think like we've just started. I think, when you think about giving your money to a fund manager, you think about, well, have they made money? That the whole purpose of Simplicity running as a non-profit is to give members dignity, and how you do that is by having choices in life, because a life with choices is a life with dignity. And how do you have choices? Money. You make people more money, money gives you choices. So how have we done in terms of that, making money? And I just wanted to show you our 5-year returns here. And so you'll see what the average has been over the 5 years for our Kiwisaver funds at the top and our investment funds at the bottom there. And they pretty closely track each other. They started at different times, so they never exactly aligned because they had a different start date, but they make the same investments. So the Simplicity Conservative Kiwisaver Fund and the Simplicity Conservative Investment Fund make the same investments. They charge the same fees. They operate exactly the same. Their just performance is slightly different because they started at a different time. We launched our Kiwisaver funds first, and then our investment funds about 7 or 8 months later. And you'll see the ranking there amongst the universe of people there. With the investment funds, it's a 3-year ranking because we haven't got 5-year data yet. With Kiwisaver, it's 5 years. It's just fresh out there. And as you'll see, we're always top 10. We're actually used to being a little higher than this. We've seen our 5-year rankings drop a little bit because in the last year, as interest rates have gone up, our bond fund has relatively underperformed, and we're going to explain that because we're not at all worried about it. We think that this will correct and be just fine. But suffice it to say that what you pay us to do is to rank very highly, and of course what we want to do is we want to be number one, and at times we have been, and we're running the business in order to do that. How do we do that? Well, if you think about managing money, I think about it in terms of the analogy of a tortoise and a hare. So, and Simplicity is the tortoise. And you know what? Being a tortoise is pretty boring, right? But just plods along and so on and so forth. The hare is much more exciting. And in our world, that's called active management. It's getting out there and picking stocks and predicting markets and all those sort of things. So if you imagine a tortoise and a hare running off there, the hare races, can race ahead initially. The tortoise just plods along. But the issue there is that being a hare can be pretty exhausting. And in fact, it's particularly exhausting if you have to run faster in order to beat the tortoise and you're also carrying more weight. And what I mean by carrying more weight is the active fund managers charge higher fees. And that means they have to do even better. So they can't just beat the tortoise, they've got to beat it by more than their extra fees every year. And after a while, that becomes extremely difficult to do. And in the world of asset management, there are these studies called the SPIVA studies. It's Standard & Poor's studies that are over a very long period of time all around the world, very, very deep, rich pool of data. And it shows how well passive investment managers have done versus active managers. And the basic rule of thumb is this: in any 1 year, the hare, those hares racing off, in any 1 year, some of those hares will beat the tortoise. But over 10 years, only about 1 in 10 end up beating the tortoise, and over 20 years, about 1 in 100. Now, if you know who that hare is that's going to win, that's awesome. You go for it, give them their money and they'll do a fantastic job. But statistically, the chances of us winning are going to be, of the tortoise winning, the low fee Simplicity that carries on having a very diversified portfolio of very high quality investments and just charges the lowest fees, that ends up winning. It's boring in the asset management sense. It's exciting for us because we love doing it, but it's not, you don't get as many things to talk about and so on and so forth, but it wins. And as you can see now, after 5 years, we're already well ahead of the pack. A lot of those hares have already fallen behind because while they're running and making a lot of noise, they're actually carrying extra weight and it gets exhausting for them. So that's where we are. Andrew, do you have sort of anything to add to that in terms of our 5-year performance?
No. I mean, it's been an exciting 5 years, and long way to go. But that first quarter of returns way back in 2016, I think. I don't know if you said there were always a few costs that you incur in the very early days. So I'm hoping that our December figures will be another step in the right direction.
Yeah. Very, very confident they will be. Alrighty, so what we wanted to do now was talk about, I guess, the general direction of markets. And I wanted to talk specifically, I'm just going to call up the right thing to you and just talk about the interest the interest rate market, basically what's happening with interest rates around the world. And I just wanted to share this screen here with you. This is, excuse me, we'll get this up here, make this large. So this is a chart of interest rates around the world, in New Zealand, I should say. And this is a really interesting chart because it goes right back to 2000, actually 2001 it starts. And this is the New Zealand 10-year bond yield. So basically what the government pays to borrow money over 10 years. And as you can see, it's been a very consistent trend downwards until the beginning of this year. And now it's blipped up again. But what you can see in that chart is it swings around, right? It's quite volatile. There is a long-term trend, and the long-term trend in interest rates for the last 30 years really has been going down. The long-term trend in interest rates for the last 700 years has actually been trending down. And there are a couple of theories about this. No one can know for sure, but the theory, and it's the one I subscribe to, is that actually this is an example of what technology does. Technology makes things ever more competitive. You know, it's hard to compete if you're a taxi driver, if you're competing against Uber, which is a piece of technology. It's hard if you're running a motel to compete against Airbnb, which is a piece of technology on your phone. It's hard if you're a retailer competing against Amazon, who have a lot of technology in terms of how they pack and ship and send you goods. So the power of technology, you know, forces down interest rates. But as you can see, they go up and down. So there are periods there, and there were periods, for example, in the 1970s, where you had very, very high inflation. So why are interest rates going up right now? And Andrew, I'm going to sort of hand over to you in a second on this, just to basically talk about the causal factors of why interest rates are going up in the world. And then we'll talk about what that means for your investments, and particularly what it means for the price of bonds, because if any of you are invested in our bond fund, you would have seen it's gone down. There's been a negative return over the last period. And you think, how can you put money into fixed interest and lose money? And we'll talk about that in a minute. The answer is you haven't lost money. You just theoretically lost some money for a while. But Andrew, could you just talk about the global drivers and why interest rates are going up around the world right now?
Sure. Thanks, Sam. And to a degree, it's there are two major factors involved. One is, as Sam's saying, that inflation has picked up, and it appears to be very much to do with supply lines. There's all around the world, there appear to be bottlenecks that are causing restrictions on supply, and that's meaning that as people are trying to buy anything, they're having to pay more to get it, or because of the scarcity of things. And so the supply is causing, as I say, a bottleneck in there. So that's causing issues. The other reason that interest rates are going up is to a degree because they were artificially low. As everybody's aware, around going all the way back 13 years ago, the central governments started doing what's called unconventional monetary policy. They started printing money. They found that actually they managed to get the world out of a bit of a problem back in 2008. And so when COVID hit 18 months ago, central banks basically did something very similar. They made money very easy to get. They printed money, and interest rates dropped quite dramatically to try and make sure that the world didn't go into a greater recession than it did. So of course, there's always going to be, to a degree, a backing up from that, and that's what we're seeing at the moment. But it's this inflation pressure which is the real sort of immediate story, and the question there is whether the pressures on supply are temporary or whether they're permanent, and therefore whether this inflation that we're seeing at the moment is simply a reaction to a short-term issue, or will this be a longer-term trend? And the reality is we don't know, and that's our answer to any of these sort of more difficult questions. But the point is, and I'll hand back to Sam in a second, but the point is that it's just staying the course. There's some asset classes will benefit if inflation picks up a wee bit. In general, it's not good for economies, but there are areas that benefit, and so diversification as ever is the key. Sam, you
yeah, great. So thanks, Andrew. So I guess there's the Andrew pointed out what is our stock standard answer, to, you know, where are the markets going? What are we doing? We have no idea. It's a random walk. The markets are a random walk. You know, over time that they will go up, because if you believe in human endeavor and wanting to make a better world and running companies that are successful and make profits, stock markets will go up over time. The long-term trend in interest rates is down. It has been a very long-term trend, but there are huge movements in between. And so we have no idea. So what do you do in those circumstances? Well, if you are managing, as we are, billions of dollars of your money over a very long period of time, the tried and true, the lesson of history that you learn is that if you have a very diversified portfolio of very, very high quality investments and you charge the lowest fees, you'll win. And I'll show you another chart, which I think really, I've shown this to you before, if those have been on these ones, but it's one of my favorite charts. This is basically a chart of the best and worst performing investment classes over the years. So if you look on the left, 2011, right at the top was the best performing one, which happened to be global private equities at that stage, and down the bottom was emerging market equities, was the worst one. You see every year. And if you have a look at that pattern, it's incredibly random. And in fact, let me ask you this question. What do you think it will be like this year? Does anyone know what will be the best, what will be the worst? If somebody does know, then they should get into fund management and or you know, and they should manage their money themselves. But it proves to be impossible to work out, because and that's not surprising that should be quite random, because if one of those things was consistently winning all the time, an awful lot of money would go into it. It would bid up the prices of all the things it was investing in, and it would underperform versus all the other ones. So it's quite natural and right that there should be a very random walk. But the right way to manage your money, therefore, is to actually have very diversified, very long-term view and charge the lowest fees. Just wanted to show you what it basically looks like if you look at if you run a portfolio that way. And this is for all Kiwisaver funds. And this is why I said there's the core message about being in the right fund. If you had a look at the last 5 years and you looked at all the Kiwisaver funds in New Zealand, and there are hundreds of them, and you put them into three buckets: conservative, balanced, and growth. There are some ones that are more aggressive at the end and more conservative, but this is where 95% of people have got their money in one of these three types of funds. And you'll see that conservative funds, which have about 21% of growth assets, that typically means shares, through the balanced funds, which have a little over half of their money in shares, and growth funds, which have almost 80% of their money in shares on average, you can see that you get rewarded for that risk, right? So that a conservative fund will be more conservative, it will be less volatile, but over the last 5 years, it has returned you almost 5%. And you've had almost double those returns by being in growth funds. Now, there's a warning in this chart here, which is that don't expect the next 5 years to be the same as the previous 5 years. 10.7% for growth funds is actually historically high in terms of returns. Andrew, do you know what the FMA or would say is the best, is what you should expect as a long-term return for a growth fund? I think it's more like about 6.5%, isn't it?
Well, they actually publish their returns after fees and after tax, and it's 4.5 after tax and fees. So it works out to about 6.5 gross, depending
that's for a growth fund.
Yes.
Yeah. So the long-term returns of all of these asset classes are lower than you think. We've just had an incredible period in certainly the last 5 years. We've had interest rates going down, which means the value of fixed interest has gone up, and we'll discuss that in a minute. And also, because that's made borrowing cheaper, that's also meant that it's flowed through to things like house prices and shares and so on and so forth. So you've had a very, very good run. Now, will it carry on? We don't know. But we do know that having very diversified portfolio of high growth, of high quality investments and charging the lowest fees is the best long-term strategy. So just wanted to talk now about the fixed interest markets. So I'm just going to try and get my screen to stop sharing here. Here we go. Just wanted to talk about what's happening in fixed interest markets, because as Andrew said, inflation is going up, and that is taking interest rates up, and that is somewhat cooling off the stock market, because when interest rates go up, the stock market can get nervous initially, but it's certainly lowering the value of bonds. And so you would have seen in our bond fund, if you've been invested there, you would have seen it actually have a negative return. So how can you can invest in fixed interest and it gets a negative return? Well, our colleague Ian, I don't know whether it was Ian or you, Andrew, but one of you put this idea in my head, and it's an absolutely brilliant one, which is how to think about what happens to the value of bond markets. And think about it like a pendulum here. And think about this end is interest rates, and this is the value of bonds. So when interest rates go up, the value of bonds goes down. When interest rates go down, the value of bonds go up, right? So that's how to think about it. So every time interest rates go up, think, oh, the value of the bonds is going to go down. Every time interest rates go down, oh, the value of bonds is going to go up. How does that happen? How does that work? Because that's a really nice way of thinking about it. But I'll try and put in the simplest possible language why that is the case. And by the way, folks, you're going to have to be a little bit patient with us here. This is one of the hardest things to explain in finance, but I'll try and do it very simply. Imagine that there were two people and they both had $100 to invest. So person A, so let's call it John and Sophie. John goes and invests his $100 and gets a bond, buys a government bond, and it returns 5%. So he gets 5% on that government bond. And then a year later, government bond rates go up. And Sophie comes in and she buys a bond which gets 6% return. So she's getting a higher return than John. Sophie's getting a higher return than John. So John comes and he wants to sell his bond. He says, I don't want this anymore. I want to sell it. I'm going to sell something. And let's say he goes to Sophie and says, Sophie, would you buy my bond? And Sophie would say, well, what is your bond returning? He said, well, it's giving me a 5% interest. And she says, well, that's not as good as I'm getting 6%. But John says, but would you please pay me $100 and it'll pay you 5%? She says, well, no, because I've got a 6% return. She says, but I'll tell you what I'll do, John. For your 5% return, I won't pay you $100. I might pay you $95. So you might lose $5 on the value of that bond, and then I'll buy it from you because I can always go and invest at 6%. Why would I buy something from you at 5% when I can get it at 6%? And John says, oh, okay, I'll sell it to you. And he gets $95 back, not $100. That's why a bond value can go down in value because the interest that it's giving you, what's called the coupon, which is the interest rate that you agreed that you would get when you bought it, is lower than what's in the market. So when interest rates go up, that means the value of the bonds that everyone's holding at lower interest rates goes down. And when interest rates go down, so think about it the other way then, imagine that it changes and Sophie can only buy it 4%. And John's got this 5% bond. And John says, I want to sell this. And Sophie says, oh, I'll buy that from you at $100. And John says, no. Mine's returning 5%. You can now only get 4%. I'm going to sell it to you for $105. She goes, oh, okay, I'll buy it then. So you can see how that swings. So that is why when you buy a whole lot of government bonds and you have it, and then suddenly the interest rates go up, those government bonds are now earning a lower interest rate than you could otherwise get. So they lose value, right? Theoretical value. But here's the really interesting thing. That's only the theoretical value. You only lose money if you sell it. If you hold on and just let it mature, you carry on getting your 4 or 5 or 6%. So you carry on making money. And then at the end of the bond term, or when it finishes, when it expires, you always get your $100 back, right? So you don't have to sell it at $95 and make a loss. You just hold it until you get your money back. And that's what we do. So when you look at the value of our bond fund, it may go down, but that's the theoretical value if we had to sell it all tomorrow. In reality, what we do is we hold on to these bonds, typically until maturity. Would most of them hold to maturity, Andrew? Would we hold most of them?
We'd be very rarely sell anything.
Yeah, so we hold it to maturity. So even though the theoretical value might be, we'll get our money back. We get the $100 back. So only if you need to have all of your money straight away will that loss be crystallized. And of course, those bonds form when the conservative fund, it's a large part of it because about 80% of our conservative funds is invested in fixed interest. In the growth fund, it's about 20%. In the balanced fund, it's about 50%. So that's why the bond market has gone down because interest rates have gone up. And that's why you can see a negative return. But that is a short-term phenomenon. If you are patient and hang in there, as most people do, they've got investments for a long time, these bonds mature and they would have returned that interest. And of course, also interest rates can go down and the value can go up. Now, Andrew, that was my best attempt. Sorry, even trying to make it as simple as possible took 5 minutes. But that's your 101 in bond maths. Did I miss anything there, Andrew? Or
no, that's absolutely right. The key to remember is that we've gone through almost a year now of rising interest rates, which has been painful. But what that's meaning is that the bonds that we own now are chugging along at a higher rate of interest. And 10 years has now gone up right up to 2.5%, which not that long ago seemed like a crazy high yield. Having said that, if you go back far enough, that still seems very low. But in this environment, and provided inflation doesn't actually get hold, 2.5% is probably not too bad.
Yeah. So there's one other comment I guess we'd make. We don't like to predict markets, but I would say this about the inflation is being driven by supply chain issues, as Andrew was talking about. So I'll give you an example. If you wanted to pay for a container to come from the west coast of the United States to New Zealand, and you wanted to rent that container a year ago, that would have cost you about $1,000. Now, to rent that container, it costs about $12,000. You've had a 12 times increase in price. Why? Because you've had COVID problems with the ports. People haven't been able to work there. You've had COVID problems generally. You've also had tankers getting stuck in the Suez Canal. You've had problems with some countries being open, others closed. It's just been a mess. The world is in a logistical mess because it's used to, of course, all being open and all being able to move. It's a very free-running machine. Someone stuck some sand in the machine with COVID. So you've had huge price spikes, and that's why you'll start to see when you buy things in the supermarket or you buy things through Amazon, you buy things from shops, you'll start to notice prices going up. Will that last? It's very, very hard to know. But it would be very surprising if in the long term, the price of a container would still be at $12,000 several years later. There seems to have been financial markets are very efficient, right? And everything's very efficient in repricing. If there's a real shortage in something, the price can go up dramatically over the short term. That flows through to inflation. So I don't think, and we don't predict these things, but it seems a little difficult to believe that the sort of shocks the world's going through are going to carry on over a long period of time. But all of that said, it's a very unpredictable world. Financial markets are very unpredictable. Best option, stay diversified, pay the lowest fees. I just wanted to share one other interesting slide here with you, which is all about contributions and about the power of compounding interest. As Albert Einstein said, the eighth wonder of the world is compounding interest. And here's an example. We just did some numbers. We thought we'd share them with you. This is just hot off the press. We just looked at taking the average person and looked at, on the average salary, what would happen if they made different Kiwisaver contributions themselves. So this is not the employer, this is your own contributions, right? And as you know, 3% is the minimum, and that's the minimum that employers need to pay you. But the average person, on the average salary, getting it's about a 3.5%, an average salary rising at 3.5%. What would they actually expect to have in their Kiwisaver account if they were contributing 3% and their employer was? And as you can see, it's about $410,000 is what you would expect to get after tax. But have a look at what happens when you just increase that contribution by just 1%. So if you increase that 1% of your salary, and we'll actually put another one there which shows how much cash you put in, but it's a very small amount. Just 1% increases your wealth by $75,000 when you retire. If you double it from 3% to 6%, you get another $225,000. And look what happens if you can manage to get it up to 10% of your salary over time. You more than double the amount of money you have when you're in retirement. And in fact, and that's because that's just the power of compounding interest. The money you make makes money. Oh, sorry, the the little bit of extra you save carries on making money, and it compounds up every year. I thought that was a very interesting slide, and we'll show you how much more next time. We'll show you how much more you would be contributing by those in dollar amounts from those extra contributions. But there's nothing more powerful. The second thing is this too. I just wanted to, I think some of you will be familiar with this too, but this is the power of low fees. Folks, I know we talk about it a lot, low fees, but it is so important. The FMA have just produced their report, and once again, they have emphasized that it does not appear that high fee managers are delivering value for money. They're just not making you more money by charging you higher fees. Here is the impact of what happened. The average person in their lifetime will spend about $46,900 in fees. They will end up with, on average, about $348,000. And the reason is, you know how we showed you $410,000 before? There are times when people take contribution holidays and might have slightly lower income and so on. But we think the average person will have about that. If you look at just the fees, identical investments, just the impact of having lower fees like we do, we're about a third of the average of our competitors because we're a non-profit. It's about $32,700 less. That compounds up because remember, all of those fee savings every year stay in your account. They earn you a little bit more, a little bit more, a little bit more every year, just like having a savings account, right? A little bit more, and that adds up to a $62,000 difference. So just by having lower fees on an identical set of investments, you end up being $62,000 better off. Fees really matter. And remember, you've done nothing else. There is nothing else that is different. Same investments, same Kiwisaver schemes, same contributions, just the lower fees. That's why we're focused on it. So I'm going to stop sharing there. And I think, Andrew, at this point, we should open up for questions here because I'm sure there's going to be lots of them over a wide range of topics.
They have been building up steadily. So thank you, everybody, for your questions. And if anybody's not clear, either on the Q&A button or the chat button, if you're on Facebook, one of my colleagues is sending through the questions, and we'll try and get through as many as we can. We've already had plenty of good ones. One thing to confirm is all those performance numbers that Sam showed right at the beginning, those are after fees, before tax, after fees, for anybody that cares. We'll start from the top. Well, let's do one which is very much front of mind for me. Is question from the MB. Do you anticipate any teething issues from the upcoming transition of Kiwisaver default members from the outgoing providers? Will Simplicity's existing funds scale without affecting existing members? Sorry. I can answer the second piece fairly comfortably. One of the things about our appointment as a default was that we have to actually set up a totally new fund. It has to be separate. So we've got a new fund will be available on the 1st of December called the Default Fund, Simplicity Default Fund. But the only difference between that fund, they're very, very minor differences between that fund and our generally available Kiwisaver Balance Fund is that there's no membership fee on the Default Fund. Sam might want to comment on that in a moment. But in terms of teething issues, from a member's point of view, and certainly our existing members' point of view, there should be absolutely no impact on your funds at all. It is going to be an interesting period. It is a lot of money being moved around between different managers. We and one other were newly appointed. And so for us, we're going to be starting from scratch. But fortunately for us, because of the investments we make and because we do keep things as simple as we do, there really shouldn't be any issues over and above getting the money from those providers that haven't been reappointed.
So for existing members, you'll find it seamless. Nothing will change. In fact, if anything, it'll be a little better because we'll be we'll just have more scale, right? And that will allow us to lower our fees faster. There is a difference between our default fund. Everyone else is at the moment, well, children aren't paying the $20 annual member fee. Clearly, the rest of us are. Default members won't be, and so we're going to do something about that. So we're lining up a Christmas present for all of our members. We'll keep you posted when we can. Can't quite tell you what it's going to be, but it probably won't surprise you.
Question we get asked quite a bit, Sam. Is there a plan to start an aggressive fund? And also, could we give any views on crypto and index funds as well?
Sure. So the aggressive fund, yeah, we do get asked this. It's the one thing that I think if we did do an extra fund, that would be one of the first ones. And also I think we should do some sort of fund which produces a reliable income. So we will do that. The issue is not if, it's just when. And so I just said, watch this space. It certainly is our intention. At the moment, we've got a lot on our plate with taking over the default provider stuff. And we've got 1 or 2 announcements coming up before the end of the year, which are really exciting. And then after that, we'll look at that. With regards to crypto, we're not invested in crypto. We think it is kind of like gambling in the sense that it's highly unpredictable. Whether or not it's right or wrong is debatable. I'm not going to take a big view on that. I think there's some ethical questions about crypto in the sense that it is, it's a place to hide money for criminals. There's a lot of fossil fuels are burned to generate the electricity to generate crypto. So there are some question marks about the industry, but there are question marks about lots of industries. But we don't invest in it, and we don't really invest in it because it really is an unregulated, untaxed industry, and we don't want your money in that. You can invest in it if you want to privately, but on behalf of you, we like to invest in regulated taxed industries and ones that have, governance and laws and regulations and policies and all those sorts of things. So yeah, that's our view on it. I personally think that crypto is like, it's like going to the casino, and some people like buying a lotto ticket. Some people like doing that. And I see what someone was saying just before, when Bitcoin's reached a new high. But that's how we view it. Yeah.
And that final question, I've read an interesting article a few weeks ago suggesting that somehow index funds were a bubble that was about to burst. I think that shows a little bit of a misunderstanding about what index funds actually are, particularly the types of funds that we invest in. The funds we invest in actually own the stocks. They own 3,000 different shares around the world. And so that's why our funds go up and down with the index. Index funds are not some sort of derivative position that has been conjured up and structured by some clever beanie sitting in an office somewhere. They're actually investments in funds, just like you investing directly in a share. So I'm intrigued to see how index funds can be somehow contributing. They could arguably be taking away the ability of people to actively manage, I guess, but yeah.
I mean, our industry, a lot in our industry don't like index funds because it's a low cost way to get the same thing. So they don't like the fact that you can go in and buy something cheaper and get exactly the same thing for a lower price, because of course they want to charge you a high price and make money for themselves. But index funds now represent, it would be between 40 and 50% of all money managed and all pensions in the world now would be done via index funds. They are huge and established. And the reason is they've been growing over a period of time because people have kind of cottoned on to, and pension fund managers and have cottoned on to the fact that, you know what, you get the same for less when you do it this way, which is why they do it. So, it isn't going away. The other thing I'd interested to say about that too is that, a lot of active managers, Andrew and I both been active managers, you're not that active. Like, you're a pretty slow moving hare, I'll tell you. In fact, sometimes it's pretty hard to tell between the hare and the tortoise, except that one just charges a lot more than the other. And the reason is that when you have a lot of money to manage, you have to pretty much track the index. You've got to buy the biggest companies, you've got to buy the most liquid ones, and you don't have any incentive to take a big risk with people's money there. So you end up being, we call them sort of passive managers and drag. And most Kiwisaver managers, in my opinion, are like that. Most of them are effectively managing most of their money passively, quietly. They're calling themselves a hare, but they're behaving like a tortoise, and they're moving even slower because they've got higher fees.
Cool. Thanks, Sam. So a question I think we've answered from Joseph, which is, given that funds are reaching 4 billion, what are the plans to reduce fees further? We can't say openly.
Well, I can tell you we've got a plan. So, and you'll hear about it before Christmas. And look, what we're going to carry on doing is just doing this over time. As soon as we get economies of scale, lower fees, lower fees, lower fees, lower fees, as low as they can possibly go, which is a lot lower than they are now. A lot of our competitors look at our fees and say, how can they charge so little? We look and we say, we're charging too much, right? And not too much right now, because we're just charging, to keep our business running. Obviously, we have to invest in the business, but we don't want to make a profit, and all of those profits we want to give back to members in the form of lower fees. So we're just going to carry on doing it. This is a story that will never end. Simplicity will be lowering fees, hopefully forever. Yeah.
So again, a question from a few people. There's one there from Curran and one from somebody else asking whether we would consider introducing the option to split Kiwisaver funds between, say, somebody can split between, say, the balance and growth. For those of us with low balances but approaching 65, it would be good to be able to choose to have, say, some of my Kiwisaver in growth and the rest in balance.
Yeah, no, I think that's a very valid question and a very valid request. So the two things we're looking at now are to have an income fund, which is even more conservative than our conservative fund, focus on income, and then an aggressive fund, and then being able to split between your allocations between that. They're quite big projects, both of those. We've just got things that are sort of more pressing at the moment, particularly becoming a default provider, but definitely on the radar. It's a very good suggestion. So thank you. Yeah.
Quick question, quick answer for a person who's anonymous. I'm over 65, but still have Simplicity Kiwisaver account and contribute, and also an investment account. Is it still worth having Kiwisaver? Should I combine the funds? If you're over 65, there is a bit of a rigmarole to go through the withdrawal process. But once that's done, Kiwisaver becomes much like an open fund for you, and therefore, actually, there's no difference between one or the other. There's no particular benefit of combining the two, other than probably from your point of view, it'll be a bit easier to manage. So there's if you like, there's no pros or cons.
And there's no difference in the fees either, so they're charged exactly the same.
Question from John. I've been hearing rumblings about a large market correction. Any concerns that you hold? That said, much has been said about things that have never happened.
Yeah, so as the market going to correct it? Look, we don't predict these things because that's a fool's game. And there have been people predicting the sky is going to fall in financial markets since there were financial markets, right? And every now and again they're right, they're usually wrong. So the long-term trend is stay invested. And if the market falls down or the market corrects, like with COVID, as you can see, those phenomena tend to be fairly short-term ones before they start improving again. So we don't predict that. The best way to cope if that happens, because it could happen tomorrow, next week, next month, we don't know. But the best way to cope is to know that you've got a very diversified portfolio of investments, which you do, 3,000 with us in each one of our funds all around the world, and paying the lowest fees. And that's because that means you don't get loss aversion. So loss aversion is a psychological phenomenon which says that you hate losing a dollar more than you love making a dollar. And if you know when the market crashes, oh, I'm okay because I've got 3,000 investments all around the world, that will help you or will help stop you making the worst decision you can make, which is panic and sell. Fear is a terrible motivator when it comes to investing. And so if you can remove that fear by knowing you're very diversified, that's the best way to happen. But will the correction happen? Absolutely no idea. And, I know that sounds crazy. I know managers are trying to predict these things and use fancy words to dance around, but financial markets are a massively complex beast. You're talking about the global economy. You're talking about what, humanity here in terms of how we operate our finances and our economies. It's way too big, way too complex a subject for anybody to reliably predict. You just can't do it.
Question from Sandy, which is an interesting one. Congrats on 5 years.
Thank you.
Nice things about how well we're doing. Then she says, beyond fees and ethical investing, do you think there's any other areas fund providers can do better or more in? Do you think the government or FMA needs to do more? Yeah, well, look, I'll only put one toe on the soapbox here, right, on this one, but you're absolutely right on ethical investing. And I think ethical investing it's rapidly becoming a massively abused word now. I think everyone's calling themselves an ethical investor, but who really is?
and and what is ethical. So I think that's an interesting one, but yes, you should absolutely do that. Obviously, they need to maximizing returns for members. That is our primary fiduciary responsibility to you. So that's what we focus on. What else can we do? Well, I think there's a few areas actually. I think that the Kiwisaver managers and fund managers generally have over $100 billion now and of money. And I think that some of that money should be invested in areas where you can both make really good returns for people, but also actually help affect change, because it's so much money and money can make a difference. And that might be investing in infrastructure. It might be investing in affordable housing. It might be doing some of these things that pension funds around the world typically do, but it hasn't happened in New Zealand. And it hasn't happened in New Zealand because A, we've been a small industry, but now we're a big industry. B, the politicians haven't been on board. They need to get on board with welcoming Kiwisaver investors into these areas. And 3 is just our industry is lazy. Most fund managers actually don't want, they only think they're going to be around for a few years. So why bother doing a long-term project? I'm not going to get rewarded for it. It's not going to affect my bonus. So I think there's a bunch of different reasons there, but they should absolutely be thinking about how all this money can make a difference. And the 4th area too is, and I am going to get on my soapbox here. I'm going to wag the finger at all our competitors here. The Kiwisaver industry, the FMA report said Kiwisaver fees last year, what was it, Andrew? $630 million, right? The amount of capital that those managers had to put in to run those businesses, virtually zero. $637 million. How much of that went to profit, to charity? How profitable was it? It's massively profitable. Trust me, we've run for-profit Kiwisaver schemes before. They're hugely profitable. I noticed one fund manager making a big deal about giving $500,000 to charity. This is a fund manager who would have made many, 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 many millions of dollars in profit that year. So it's, this virtue signaling about being a charitable industry is rubbish. Managers should actually step up and either do something like ourselves, and there are other managers who do this as well, and say we donate a proportion of our fees to charity because it's the right thing to do, or charge lower fees and make less money. But could they, quite frankly, stop being quite so greedy and be a little bit more generous? And so I'd like our industry to do that. Finance industry is not famous for its generosity, but that doesn't mean that it shouldn't be. It damn well should. I'll get off the soapbox now.
That's great. Thanks, Sam. And we're still being asked, I'm not getting through many of these very quickly, we're still being asked quite a lot about Bitcoin. Some of you may be aware there was a Bitcoin ETF, which is an exchange-traded fund, issued the other day, which seems to have sort of legitimized Bitcoin, and now everybody's saying, well, you can invest in it because it's listed on an exchange. There's somebody else here saying, which is a perfectly reasonable comment, that it's the best performing asset of the decade. Why are we not invested in it, essentially? I think Sam's covered off most of it. From my point of view, just a very quick comment from me, is only that it's still very much at a fledgling stage. It's still unregulated. There are some serious questions about some of the structural positions in that. I don't agree with the comment from Anonymous here that the ethical concerns have been addressed. I don't believe that's the case at all. And it feels very much to me like the end of the 90s and the 2000s, the dot-com era, because there is no doubt in my mind that blockchain has valid uses and reasons for being there. And there probably are some cryptocurrencies which will still be there in 10 years' time. But there's an awful lot of hype in there at the moment. And it seems to be that you've just got to launch something that says it's cryptocurrency and it goes up in value. And that to me reminds me of the dot-com era back in the late 90s, where, and once again, in those days, I was far too skeptical and far too cynical and didn't get involved. But equally, I didn't lose my shirt when the thing collapsed. And
I think also, and you're right, Andrew, but you also have to, we need to differentiate a couple of things here, folks. First of all is we love blockchain. Everyone loves blockchain. Blockchain is not crypto. That happens to be the architecture behind it. The cryptocurrencies are invented, literally, currencies as a store of value, and that's perfectly okay. Anyone can do that. So to my mind, there's no difference between a cryptocurrency and Beanie Babies or marbles or antiques or anything that you want to invent as a store of value. That's absolutely fine. So they're not going to go away. People will want to be investing in crypto and putting their money in. Crypto won't go away. It's here to stay. But will it be a means of exchange? That's the interesting thing. If it's a means of exchange, it will need to be regulated. It will need to be taxed. And then it becomes another currency. And then it gets a legitimacy to it. The problem is that if it becomes regulated and taxed, it becomes just another currency. And so and then you'll have a view: would you invest in the yen versus the dollar versus versus the euro or whatever? And then it may be considered another currency and have a store of value and a method of exchange. But it needs to have both, and it doesn't have that at the moment. So I don't think crypto is evil and so on and so forth. It's just that until it is a method of exchange, it doesn't actually have that much. It has theoretical store of value, but it's not earning anything. It's highly volatile. It can be regulated away, and it can be lost. And we just don't invest in those sort of things. Yeah.
Cool. Okay. No more cryptocurrency questions today.
Well, it's great. It's great that we're having this discussion, eh?
I agree.
And folks, I don't know whether, if Andrew's right, back to the 2000s, we were both working at that time. I don't know whether, you could have bought pets.com worth zero or Amazon.com worth a fortune, right? It may end up being a fantastic investment for people, but until it operates in a regulated manner, we can't invest in that.
Quick question for Lance. Since bonds have gone down in theoretical value, should I buy more bonds at this time? That's that same old answer, I'm afraid, Lance. We've got no idea. The reality is simply that, as I said, that interest rates now are back to a level which at least gives you some protection. 2.5% is not a lot, but it's a lot better than it was. And whether it's worth buying here, it could be 3 next week, but over the long term, those bonds will pay back and will actually have a positive return. Somebody called Daly is asking, what is the average salary? Probably work it out from our accounts, but we're not likely to. So, I mean, just suffice to say,
simplicity.
Yeah, I guess so. I mean, I think, Sam, obviously there's privacy issues all across the board, but fundamentally, our staff are recompensed for their work. Some of us know we could probably get an awful lot better in the private sector. Sorry.
I think it's fair to say, I don't want to hazard a guess at the average salary, but you'll be surprised how low it is, not how high it is. I think pretty much everyone is getting paid less than they otherwise would, but they do it because they love working here. We have a social enterprise and a purpose and a charity and so on. We also have 63 volunteers as well who clearly work for nothing. But just to let you know, our working conditions are interesting. It's very flexible working hours, so you can work from home, and total flexibility about when you turn up, where you work from, and generous terms and conditions. So, Andrew,
I've just had a text from somebody, one of our colleagues, saying the average salary we're working with is on that example that you had for.
Oh, is it? Oh, okay.
So, and the average salary is $47,000. According to Stats New Zealand at the moment.
Right.
So that example works for 47,000. Sorry.
Oh, so the average salary that you're looking for the example, not the average salary of what we were paid.
Yeah, sorry, misread it.
Okay.
Oh, well, there you go. Question from, comment from Logan. Sam, can you please become the next Prime Minister and sort out our country financially? There you go.
I would be a terrible politician. I'd get myself into trouble in the first day. I have too many opinions. Thank you very much for the suggestion.
Yeah, quite. Okay, so this one's one that's a bit more straightforward to answer. Can you explain the different mix you use for some funds from others out there? Generally, you seem to hold less or no property in some funds. Do you want me to go with that one?
Yeah, you go for that.
So the way that we decide on the allocation between conservative, balance, and growth is we look at the largest 12 providers, and we work out the average of what they hold, and then we basically hold that average. And we know that because we charge a lot less than them, over time, that will mean that we move to the top of the pack. We don't specifically hold property as such. We've got some working on a sort of property option, but that's in the future. Right here, right now, the only properties we own, or the only property stocks we own, are those that are listed within the funds that we hold. So within the New Zealand share fund, there are 3 or 4 property stocks. Similarly, in the global index, there are quite a lot of property stocks. So that's how we take our property exposure. We didn't feel that when we established the business right back in the early days, we didn't feel that we needed a specific property exposure because we already have one through the listed shares. Is there anything you want to add to that, Sam?
No, I think that's about right. Yeah. Remember also that when you're investing anywhere in the world, generally you're investing in property, right? The famous example is McDonald's. You know, you think you're buying a fast food chain, you sort of are, but actually a lot of the value of McDonald's is the value of the properties that it owns. And that's the case with a lot of companies. They have a lot of money invested in property. Yeah.
This is an interesting one. I really like that ethical investments are a cornerstone of the business. However, who decides what an ethical investment is and what isn't? Are they looking at it on an ongoing basis? Is it a one-man decision by Sam or a committee?
That's a really good question. So the answer is it's actually made by a very large group of people overseas, with Vanguard, who manage our overseas investments, and also Morgan Stanley Capital, or MSCI. And they sit down and they run ethical screens. We exclude 8 different areas and we apply 4 UN principles. So it's absolutely not my decision. And those screens are applied to New Zealand, and we have a couple of companies we won't invest in here, large ones, for example, Sky City, because it's a casino, we don't do gambling. Equally, also Genesis Energy, because they have coal-fired power plants. So, but those screens are very methodical. What really annoys me about the ethical investment, what does it mean? What does ethical mean? Because one person's ethics is different than someone else. So you have to have a process. It has to be a methodical process. And, you know, not everyone is going to agree. So it's a very easy term to say, but it's a very hard thing to do in practice. And so, no, we don't sit in New Zealand and pass judgment on the ethics of a business overseas. We actually, because, you know, how could we possibly get that right most of the time? So there's a very large group of people who do it. And in fact, we have been instrumental with Vanguard in getting these funds launched in this part of the world so that all people can invest in them, which has been great. So I'd say the other thing about ethical investing too is that remember also that we are managing your money and you are shareholders in these companies. So we have an obligation to act on the shareholders' best behalf and be activist shareholders in New Zealand. We've done this on issues with regards to diversity. We're about to launch this thing on CEO pay as well. And we feel that you have to be an activist. You actually have to get out there and try and get New Zealand companies to behave better. If you're sitting in an ivory tower, if you're sitting in the tallest office building in Auckland and you're sitting down there and you're passing judgments and saying, because we don't like you, we won't invest in you, that's only one part of the story. That withdrawing money is one part of the story, but actually being invested and actively investing in companies that pass those ethical streams, but trying to get them to do things better in the interests of New Zealand and long-term shareholders, that's what we should be doing as well. That's what Kiwisaver managers should be doing. Most don't, because most of them just don't like to upset anybody, right? Banks won't do it because they want to lend to the companies. Why would they want to annoy the board of directors of a company if they want to lend to them? So there's conflicts all over the place, but I think that there's a moral obligation on large Kiwisaver managers to actually get out there and try and get the sort of things which will be better for New Zealand, but most importantly, better for the members in terms of higher long-term returns. And we see ourselves in that role very much.
Great. There's so many different questions here. This one's quite a good one, so we'll go to that. From Rob. When I got involved with about 3 years ago, one of the most compelling simplicity concepts was to amass Kiwisaver dollars and start a journey to back New Zealand from foreign ownership. How are we tracking? Do we bias the investment strategy to invest in NZ companies?
Well, as Andrew said, the asset allocation we actually borrow. So, all of our 12 biggest competitors all have strategists, economists, and so on. They come up with asset allocations. We take the average of that, and that's ours. So we mimic what they do. So we're not actively saying we're investing more in New Zealand versus overseas, because our responsibility to you is to maximize your returns. So, but that actually means we do have a lot of money invested in New Zealand because there is a home market bias. And what we have done also is invested in Icehouse Ventures, which gets involved in the startup New Zealand companies. But then also, most importantly, when they get to a certain point where they run out of the ability to raise money domestically, we help them along with a little bit more domestic investment before they have to race off to Silicon Valley and raise money there. We just like to be one investor there. And so we help them stay in New Zealand a little longer. I mean, they will physically stay in New Zealand and work, but we help to get more of our members invested in those. So that's one thing we're doing. That's tracking very well. We've launched that 18 months ago, and we have about about $45 million, something like that, invested in that strategy, Andrew, around about that.
Yeah.
So that's actually starting to make a difference, and that's really cool. The other thing we have done is we've taken on the banks and mortgage lending. We've decided that Kiwis are just getting ripped off with mortgages. We think they're low, but they're really high. So we've started lending to our members directly. And as you may know, we have the lowest floating rate first home mortgage in the country by far. And there's one other initiative that we'll be launching in a few weeks as well, which will let you know, which will make we think over time, a major difference to the quality of life that a lot of New Zealanders have. So watch this space.
Great. Okay. Well, there are a few quick questions I can answer to get through some of these. Question from Dave: Are the loans you give to first-home buyers fixed or floating for 30 years? They're floating. I think they're generally for 25 years, but we charge a floating rate. Is there any disadvantage to having a Kiwisaver and investment fund besides paying membership fees twice? The key difference, Jaden, is that your Kiwisaver funds are essentially locked in unless you're buying your first home, whereas investment funds are available to you at 2 or 3 days' notice and are completely unlocked. From another Andrew: I've just joined Simplicity. I've not bought my Kiwisaver from my last fund. I'm 68 now, and I was advised to go for your investment accounts instead. What is the difference in terms of returns in a balanced investment account compared to going for Kiwisaver? What are the advantages? I have a large sum to invest soon. The essential point here, Andrew, is that our balanced fund, Kiwisaver and non-Kiwisaver, is exactly the same. There is no difference between the two at all, other than if you're in Kiwisaver and you're not 68, you can't get your money out. In terms of the return you're going to get in future, unfortunately, we just don't know. We can give you an idea over the very long term, but that's only really based on what we're permitted to say by the regulations.
And what the FMA says, is, Andrew, is that after tax and fees, you can expect about long term, about 4.5% out of a conservative fund, 5.5% out of a balance, and 6.5% out of a growth. But that's for all Kiwisaver funds. Obviously, we'll try and do better than that, but long term, that's what they want people's expectations to be set at. Yeah.
There's one here from Jeffrey. Thanks for the great presentation. I'm currently working in Australia. Do you know of any Australian investment funds similar to Simplicity? Unless one's come up more recently, we haven't found one. We've been really surprised, but there doesn't seem to be anything over there.
Boy, if you think New Zealand fund managers are making a lot, go over to Aussie. Amazing. They manage $3 trillion and they're still charging high fees.
Question from NB: do you plan to make Simplicity home loans available for refinancing?
Not at this stage, because we have plenty of demand from first home buyers, and we think that's where the greatest good can be done, to getting people into their first home. Also, from an investment point of view, first home buyers have the lowest default rate, so they're also the safest form of lending, and we have a fiduciary obligation to our members to invest their money, in a safe way. So no, not at this stage. I'll tell you the other problem too is if we open it up for refinancing, I mean, there would just be we couldn't possibly satisfy demand. As it is, about $10 billion a year is lent out to first home buyers in New Zealand. If you took into the refinancing market, that would be, I think it might be north of $100 billion. In fact, it would certainly be more than $100 billion. We don't have that amount of money to invest yet. So I'm sorry, no, but it's just we have to look after first home buyers first. Who are our members? Yeah.
A question from Patrice about splitting. I think between funds we've covered that one. It's something which we're looking at. Somebody's asking anonymously: could you please explain the difference between index funds and ETFs? Difficult to do quickly, but I'll try. And Sam, you chip in if
Well,
you think
can
of
I just do
something
a
else.
one-liner here? Because I think there's a one-liner.
Go.
ETF is like an index fund, but it's just listed on the stock exchange. So an index fund you buy directly from the manager, like us, we do index funds. ETFs are index funds which are listed on the stock exchange, and so you buy and sell it on the stock exchange. That's probably the simplest way of putting it. Otherwise, we could get into 5 or 10 minutes of explanation here.
Yeah. I mean, they are essentially the same thing, but one, as you say, is listed. Question from Jenny: the bond fund seems to attract higher tax take than the growth and NZ share funds. Is that correct? Actually, Jenny, probably is correct in a way, because in a normal circumstances, the bond fund accrues everything it accrues counts as income. So you're taxed on the whole thing. Whereas with the growth fund, 78% of its investments are in shares. Overseas shares are taxed under a regime which means you pay tax on a 5% return. And New Zealand shares, you pay no capital gains tax, you only pay tax on the dividends. So effectively, the tax rate within the bond fund is higher, essentially. So yes. Question from Joe: my employer has it stated in my contract that if I have Kiwisaver contributions, my wage is lowered by 3%, basically meaning they aren't contributed. Cheeky, but hey ho. With that in mind, am I right with my assumption that the cost of me using your non-Kiwisaver services is only costing me the annual government lump sum, but in exchange getting the flexibility of accessing it before 65, if I ever wanted to, or if government increased the mandatory contribution? I think Joe's right, isn't he? That's exactly what he's got.
That would be right.
Is there any disadvantage to having Kiwisaver and an investment fund besides paying membership? Sorry, Jaden, we've covered that one. Have you asked? Good one. Thank you, Frank, for finding one that was a bit different. Have you heard of B Corporation certification? If so, any thoughts on that? And if not, might be worth a look.
Yeah, look, we looked at B Corps very early on, and look, we're so eligible, it's ridiculous. But the weird thing about B Corps is it doesn't cover non-profits and charities, so we can't be a B Corp. If we could, we would have, I think, early on. I like the idea of B Corps. But here's my worry. My worry is that more and more people are becoming B Corps. Is it becoming one of these badges that you pay for, badges for hire? And where have there been examples where B Corps have been thrown out for breaching? You know, I think there was a bit of a controversy my partner was telling me about with regards to Patagonia just recently. So, you know, these things often start out as a great idea and then they become quite big and commercial and driven by the money of it all rather than the principles of it all. And I'm not sort of anti-B Corp at all in that sense, but that would be my question mark if we were coming to them again. How credible is it? And the credibility for me is not getting in, it's being thrown out. So if I see an example of members being thrown out for changing the way they do things or, you know, lying or misrepresenting, that's a good sign. That's a very good sign. I haven't seen a lot of that from B Corp, but I may well be wrong. But unfortunately, we can't even consider it because the crazy thing about B Corp is they focus on the corp, which means you've got to be a for-profit corporation.
Great. Quickly tick off a couple of these that gets rid of things. Question from Caroline: do you think the government should increase their yearly contribution, or do you think that they will do away with it eventually?
Look, I don't really have a view about how much, but I have a view about who should get it. I personally think that Kiwisaver should now be compulsory, and then I think that kids from 0 to 18 should get $500 contributed a year into the account so that, you know, when they turn 18, they've got a pool of money which is theirs for, you know, buying first home or whatever. So there is mana in money, and there are too many kids who get to 18 with nothing. Having something in the Kiwisaver account which is for them, no one else can touch it, for their benefit, they can use it for hardship or buying their first home would be great. That's my personal view. but there needs to be incentives, right? And the employer contribution is sort of an incentive. But I just think we've got to the point now where, as a nation, we need to do a deal with ourselves. There needs to be a social compact where all citizens agree that if you are working and earning money, you should save a little bit for your retirement. And I think that Kiwisaver should be the safe place for that to be, and that everyone should have one. And if you're not earning anything, you shouldn't have to contribute, but you should still have to have a Kiwisaver account. If the government can afford to put a little bit of money in every year, fantastic, as they are now. That is reason why, by the way, if you know anyone who doesn't have a Kiwisaver account is over 18, get them online and get them signed up. Don't even care if it's with Simplicity, just get them into a Kiwisaver account, putting in $20 a week, and then the government will give you $10 a week of subsidy. It is free money. That $10 is a 50% return on the $20 every week. So it is the only free money I know of in the whole country. Every adult must have a Kiwisaver account and be contributing $20 a week, a minimum of $20 a week. It's the best investment ever. That would have massively outperformed Bitcoin.
Okay, quick question from Jennifer. Is there any way you can show values that are more current than 3 days old on your website? The problem is, Jennifer, that it takes 3 days effectively for the assets to be valued, for the unit price to be calculated, and then it goes up on our website. So we're always working quite a few days behind. I'll have a chat to the tech guys and see if we could speed it up a little bit, but I think unfortunately that's just a function of the way that unit pricing works.
Yeah.
It's
a function of third parties. It's also a function of time zones, because markets close at different times during the day here. Then they need to be valued on their closing price. So it's actually quite hard to get it all going. I've looked at this beforehand, desperately wanting to get it down to 1 or 2 days, and there are too many third parties involved. And of course, it has to be right. So it's got to be done properly.
Question from Josh. Will you consider a green sustainable fund?
Not at this point, Josh, and I'll tell you why. Because what is green and what is sustainable, in the sense that what we try and do is apply those principles to everything that we do. I mean, as a business, we operate sustainably. We want companies to think long-term sustainably. We're an activist shareholder in getting them to think that way in various areas. So in a sense, I would rather that those principles were applied to every dollar that we manage, rather than having a fund specifically for that area. This is one of these things that annoys me about fund managers who have an ethical fund. So what? So are all of your other funds unethical? You're perfectly happy to do anything for money, are you? It doesn't matter whether it's unethical or ethical, as long as you get a fee. So, if you're going to do these things, I think you've got to apply it to every dollar that you do, because it actually matters. It actually matters. So green and sustainable trusts, I mean, goodness, we're planting tens of thousands of native trees a year. Environmental charities are really important. We run our business highly sensitive to that ourselves, and we make investments sensitive to those things. So I'd rather it was in our DNA as a business and everything we do had a green tinge to it, rather than going dark green in one tiny part of the business so that you can, not have to do it elsewhere. I think that's ethically wrong.
Great, thank you. Question from John. Your investments seem to be tailored for younger people doing regular contributions. Do you have funds for older people who have lump sums to invest? I mean, to be honest, John, our funds are yes, you can set up regular contributions, but equally, if somebody wants to put in a lump of money, we're certainly not going to say no. We
have lots of retirees who do that, right? Lots of members over 65 who put large sums of money in one-off. Now, the funds are designed to do both. They can take as much money, and you can get as much money out as you want to at any time. And yes, a lot of people contribute regularly because that's the nature of Kiwisaver, but you're certainly very welcome to put lump sums in and out, or do regular withdrawals if you want to. Our investment funds have got, it's almost over $2 billion now, Andrew, or pretty close to it, right? Anyway, an awful lot of money, and an awful lot of that is lump sums from people who've just wanted to make one-off investments.
Yeah. This is more an observation than a question from Richard. Many passive many large passive ETFs in the US have much lower fees, presumably because of the greater scale. Absolutely, Richard. And we'll keep working towards getting our fees down. That's very much the intention over a long period of time. We're compared to the size of those sort of markets, we're minuscule as yet.
I think you're sort of right, Richard. But some of the, if you looked at the multi-sector ones where they do asset allocation and bring in multiple ones, we're pretty competitive with those fees on ETFs, even with the really big ones overseas. But when you get a single sector fund like international equities or the Dow Jones Index or the government bond index, yeah, then those fees can be a lot lower because they're a single sector fund, much easier to manage once you do multi-sector. But you're absolutely right. What do we want to do? Get our fees down even further. Yeah. I mean, one of my aims is for simplicity to be tremendously unpopular with our competitors because we just keep on lowering our fees. I think we've already started off doing that. Just keep on lowering fees and keep on telling them, why aren't you doing it? Yeah, why are you making so much money from ordinary New Zealanders? Yeah.
Another question from, I assume it's the same, Josh. Will you consider an Aussie New Zealand combined share fund to avoid capital gains tax? That's a very good question, Josh, and it's something which is on my agenda to address in time. Is getting rid of the tax that we have to pay because they're overseas. But it's just, we just don't have, believe it or not, we don't have the critical mass yet to do it. In time, we certainly will. Anything you'd want to say on that, Sam?
No, I think that's fine. Yeah.
Joseph, with index funds booming, the question is whether it would artificially inflate the value of stocks despite its intrinsic value, because everyone is throwing money at stocks, demand driving bubble.
Well, that's an interesting comment. The answer is yes, it's sort of true, but it's not index funds' fault at all. Just the active managers like to point the finger saying, oh, it's all these dumb people putting money into the markets. They don't know what they're buying. Rubbish. Most active managers are doing exactly that as well. In fact, if you looked at the true active investors in the market, I'm betting, and I'm just guessing here, it would be less than 10% of the trading is from genuine active trade, 90% of the money going in. And people are saying, well, are they just making dumb decisions, inflating it? No, the value of the stock market reflects the value of the fixed interest market. So if you're not getting very much money in the bank and you need that money to live, you're going to be putting your money into riskier assets like the stock market. So stock markets go up for a very logical reason. There's a great phrase, short-term markets are a voting machine, but long-term they're a weighing machine, right? So the markets go up for good reasons, usually. Very rarely do you get genuinely irrational, crazy bubbles. I personally think we might be experiencing one of those in crypto right now, but we'll see. But this is a demand-driven rise, but for pretty sensible reasons.
I'm not sure what to make for, again, an observation from Richard. JP Morgan's answer springs to mind, they will fluctuate, which I think is
markets will fluctuate.
It's a bit like ours. We have no idea. Quick answer for Andrew. If you split between 3 different investment funds, you pay 3 sets of fees. You only pay one membership fee. You pay fees for each of those funds, but all at the same rate. So I think the answer there is that the $20 per annum is only charged once. Interesting observation here, which I guess is still covering what we've been talking about. You say 50% of the market is passive funds. Would 100% passive fund market be inefficient, stagnant? If so, where would the tipping point be?
Yeah. Well, if it was 100% passive funds, that means everybody would just be buying and holding, and there'd be very little transactions going on. So you're right, it would be stagnant. But you remember there are always people who are, trading actively, generating activity. So 100% won't happen. But theoretically, would that happen? Yeah, you'd be absolutely right. That's what would happen if it was that. But it's never going to be like
that. Question from Daly. Do you have any advice for a $25,000 gift now in US dollars? How would you compare investing in US market versus bringing the fund to New Zealand and putting it with simplicity? We're not high earners and need to be careful. Unfortunately, Daly, we can't give you any advice on that sort of thing. You actually have to go to an advisor or have a look at things like sorted.co.nz, which give you some ideas and details, but yeah, Sam, is there anything you want to?
And bear in mind that if you bring it to a fund with us or another fund manager, of course, a chunk of it will be invested in the United States shares anyway. So, but, you know, if you need to be careful with your money, like, what are the golden rules here? Diversify, diversify, diversify. Pay the lowest fees if you can, and you know, and if you do those two things, you're going to solve most of the issues. But of course, that's not personal advice. We can't give you personal advice about your circumstances. But those golden rules I usually find apply in nearly all circumstances, and it's certainly how we run our business.
And so there's somebody here offering to talk you through your misconceptions about Bitcoin. Do you want me to follow that up at all?
Listen, there are some very passionate people about Bitcoin, totally understand it. I totally get, and I actually have done quite a bit of reading on what it represents and why people think it is the future. And a bunch of it I agree with, for sure. But as an investment for us, no, not until it's regulated and taxed and reliable in that regard. Until then, it is basically gambling. And I just, one other thing about it, because I know a lot of people talk about it being a medium of exchange, and they say, look, I can get my money back, I can turn it to US. Yes, you can. People at the margin can do that. There's a small amount of that which gets turned into liquidity, and people say there's an ETF in it now, which means I can get my money in and out. Well, that's just like you could beforehand. You know, some people would give you US dollars for Bitcoin, but that's not what I mean. What I mean by a method of exchange is that you can go down the road and buy a pizza with it. You can't. And until you can, it's not a currency. So it's crypto, but it's not a cryptocurrency. A currency needs to be a free method of exchange to buy goods and services. So it may well end up being that, and wonderful if it does, but until then, it's not anything that we can invest in, yeah. Because remember, once you can buy a pizza with it, it's going to be regulated, it's going to be examined, it's going to be transparent, it's going to be taxed, all those sorts of things, yeah.
Nice comment from Chris. Many thanks. I just changed my Kiwisaver to Simplicity. My wife is with Simplicity. We had the same amount invested in 2 different providers, and we've watched hers climb higher than mine. Just made the switch. Thank you, Chris. Do you think, question from John, do you think providing an individual investment advisory service is the next part of your investor education efforts?
It's an interesting one, isn't it? Because we are always looking for true fee-based advisors to send people to for advice, and they're so hard to find. I think, you know, the genuine fee-based advisors who don't take commissions or a cut from product suppliers probably count on 2 hands in New Zealand. So that sort of leads us down the path thinking, should we try and do it ourselves, or should we try and do some sort of blend of an online and in-person service? Look, it's on our radar. We're thinking about it. And also, you know, could we do a little bit of it automatically? Could we do, you know, robo-advice as well? And I suspect there's some sort of blended solution there. You know, the online, because remember, already you can get a lot of advice online already. It's really good. There are some really, really good financial commentators out there and personal finance experts who are fantastic, that are giving you free advice, you know, sites like Money Hub and Sorted and so on. And there are some bloggers, you know, which it's just awesome as well. And then, so maybe the personal financial advice bit of it is the extra 10%, not the 90% of the solution. But we're thinking about it, yeah.
Fairly specific question from Brendan. In the future, will you consider offering Simplicity home loans for apartments under any circumstances, e.g. would equity of 25 to 50% for a quality recent built apartment potentially reach your risk threshold within the coming years?
Yeah, so we considered it last month about the possibility of doing it. We just decided not to for the moment, because there's a lot more work that we need to do to understand the issues regarding body corporates and apartments, and also build quality, because, you know, these things get signed off and then you find out there's a problem later. And we obviously have a fiduciary responsibility to our members who are supplying the money to lend here, to make sure that it's a very high quality lend. So the answer is potentially yes. We have to do some more work on it. So I can't say definitively yes or no, but it's on our radar, yeah.
Question from Kate. Love the question regarding ethics. How does this apply to long-term game investments such as things like ecosystem restoration, regenerative economies, and beyond instant monetary values linked to existing measures of GDP?
Yeah, that's a very good question, Kate. And, you know, all of those things, to my mind, are inherent to the long-term successful running of any for-profit business, right? So regardless of whether it's a social enterprise or charity, let's talk about the businesses we invest in. Unless you're starting to think like that, and I mean starting to think like that, there's not going to be, you know, you're not going to get a major multinational will overnight transform their systems and processes that way. But they absolutely should start thinking that way, because that is the long-term future. And the responsibility of ourselves as shareholders in these companies, and remember, the boards of directors of these companies work for us, the shareholders, for all of us. They need to start building that into their long-term thinking. So in as much as we have say with them, and we go and see and talk to them all the time, we say, you've got to start thinking about long-term sustainability. Here are examples of things. That, to my mind, makes a much bigger difference. And that's why I think there's a responsibility of shareholders like ourselves to go in and advocate for change, because changing the whole beast is way more significant for the environment, for sustainability, than doing one specific piece of, let's call it greenwashing or ethic washing or one little fund. That's marketing. That's not substance. So to have substance, you've got to go on and try and change the whole beast. That takes time. You know, these businesses are super tankers. They turn slowly, but you've got to start, you know, you've got to turn the wheel, right? So we want to get the board to turn the wheel, and then the beast will turn.
Question from Diana: is offering loans adding risk to our investments? I'll give you a rest for a second, Sam. We only do loans against to first home buyers, and they have to have at least 20% deposit. We feel those are exactly the type of loans that a bank would do any day of the week. So we're almost taking the cream of the mortgage market in that respect. So we're taking as little risk as we possibly can. So compared to us having an investment in a bank, it's probably less risky in our opinion. But it's certainly the only issue with the loans is liquidity. We can't sell them tomorrow. But equally, the more our mortgage book builds and becomes larger, and we'll have lots and lots of very small loans, we see it as very much just a positive for our members' returns. And Meg's asked, will your mortgage lending be available to someone who has owned before but is struggling to get back into the housing market? I have the deposit in my 50s. I'm struggling with the term of the mortgage. I do not need to use Kiwisaver funds for a deposit. That's probably along the lines of, are we interested in getting more broadly involved in the mortgage market, Sam?
Yeah, look, we will be conservative in terms of how we lend, because we're lending members money here. So we need to make sure that it is a very conservative, lending process that we go through. So I don't understand what your specific circumstances would be here in terms of how much deposit, but by all means, go online. We've got a quick calculator there which can tell you how much we can lend you. Yeah.
Question from Matt. Hey guys, why not emerging markets? It seems like an active decision. Many forecasts of long-term asset class returns reckon that EM will return higher than US and Deutsche Marks.
Sure.
Go.
Well, look, I'm a 30-year veteran of investing in investment in emerging markets. I used to work for several large organizations who did it. And the reason we don't invest in emerging markets is really for the following. Historically, they have not outperformed. In fact, historically, you've taken on a lot more risk for lower returns. And the reason is the markets themselves are not efficient. You know, these can be corrupt countries, very illiquid markets. They can become highly fashionable, and people can talk about them being the exciting part of the future, and they are in many ways. There's going to be, fantastic global growth from them. But the issue is the investability of those markets. Very often the most exciting companies you can't invest in those markets anyway, and the ones that are listed, tend to be illiquid, difficult to own. The other reason is that when you own big multinationals like we do, top biggest 3,000 companies in the world. A bunch of them are in emerging markets, but an awful lot of them have emerging markets operations. So let me give you an example. When you own Procter & Gamble or when you own Unilever, they have massive emerging markets businesses. And so you're effectively getting exposed to that high growth part of the world via a company which is extremely well organized, highly liquid, listed on big stock exchanges. So many of those 3,000 companies we're invested in have a lot of exposure to emerging markets. It just so happens that they're listed in London, listed in New York, listed in Singapore. So you think they're a US company, but they're not. I mean, Nike, Apple, Procter & Gamble, Unilever, these are all multinationals, So effectively, we think we have a lot of emerging markets exposure while we're still investing in, high quality liquid companies.
What's the time? Goodness me, it's 1:30.
Okay, we've still got 85 people on and a few more questions. Let's go for it.
Yeah, just keep going. Okay. Now, a question here from Fernando, and it's a little bit more difficult to answer, and I'm not a tax expert, but in terms of the deductibility of interest costs if you're investing, to be honest, I have no idea.
No, I don't have either. I think we'd have to take that one offline and get back to Fernando.
Sorry, Fernando. It's not.
So, Fernando, if you send the question to info@simplicity.kiwi, you can send any team, anyone on the call can send any question to us, and we'll get back to you on
that. Josh has come back and said, regarding green sustainable fund, yes, that applies to all funds, but there are companies that are cutting edge of sustainability and driving the technological change that will help us to combat climate change. I guess investing in companies that have an outsized positive impact.
Oh, I see. Yeah. Well, actually, we sort of do that via Icehouse Ventures because those are exciting companies. I mean, I personally think that let's call it the sustainable environmental ethic that passes will be the greatest generator of new value in companies over the next generation. There's just going to be a massive wave of innovation. I'll give you an example of one company we're invested in right now, Mint Innovation, right? Now, Mint recycles electronics effectively. So that's a very, very environmentally sound company, huge growth profile, very exciting. And that will be an example of the sort of companies we'll invest in. And a bunch of those will get very big as well. I would not be surprised, if you had a look back 20 years, the 5 biggest companies in the world, most of them were oil companies. Now they're tech companies. I would not be surprised in 20 or 30 years if the 5 biggest companies in the world are mostly environmentally focused companies as well. There's just going to be a huge amount of money in innovation because we need to do it. It's not an option, it's an imperative. And money will go where the opportunity is and where the need is. Yeah.
Few interesting ones about different accounts. Can you develop joint, this is from Gail, can you develop joint grandchild investment funds that parents can't get access to, only the child at 18, or multiple investment funds held in joint names for the benefit of the child? And on a similar note, Patrice asked, has Simplicity thought about setting up an investment fund parents can pay into for their children's education?
Yep. Well, the investment fund you can set up straight away for your kids and put money in. Lots of people do for their education, so you can do that right now. So the second question is absolutely yes. The other one is on the joint grandparent-grandchild funds that the parents can't get access to. Well, a Kiwisaver fund, of course, gives the kid access to money, but only for hardship by their first home or retirement. If you had an investment fund in the child's name, I think the law is the parents can probably still get access to it, even though the grandparents set it up. So I don't think you can legally do that. And I don't think we would be allowed to legally be able to do that legally, even if we wanted to. So I'm sorry, no, I don't think so. I guess the only thing you can do is set it up and don't tell the grandchild or parents about it, and then give it to them when they're 18, which is actually what a bunch of people do as well, right? They set them up for their kids and even in their own name, and then they give them the money when they're 18.
Great. So question from Ray, can you make manual contributions to Kiwisaver even if you're employed? And the short answer, Ray, is yes, you can. There's nothing stopping you if you want to contribute something into your partner's if your partner wants to contribute something into your account, they can do. As you say, to get the government contribution. No, absolutely, there's no problem with doing that at all.
Last two questions, I think.
Well, there's a few. Yeah, okay.
Yeah. Oh, no, sorry, I'm looking at one list. There more, are there? Okay.
Yeah, there are.
Okay.
But that's fine.
That's cool.
It's a good one from somebody, again, anonymous. I have two investment funds with each with the same amount. One's with us and the other's with another managed provider. Both have different weightings in the same or similar markets. I tell myself I'm balancing my risk by doing this. Am I fooling myself, and should I place it all with Simplicity? Well, you know what we're going to say. We're going to say put it all with Simplicity. But depending on the nature of the, I'm going to cut in before Sam says that.
Yeah.
Depending on the nature of the other manager you have, that is another way of diversifying.
Totally.
And actually, from our point of view, we're always interested here, as per somebody's comment earlier, how two identical amounts of money are managed by two different managers.
Yeah, look, it's whatever makes you feel most comfortable. Honestly, we don't make any more money if you give us all your money or none of your money, right? So that's absolutely fine with us. Is whatever makes you feel the most comfortable, to be honest with you. Certainly, if you gave it all to us, it would be 3,000 investments, regulated by the public trust. It's all safe in that regard. But if it makes you feel more comfortable spreading it amongst managers, then you should do that, yeah.
Question from John. What is your future policy on affordable housing? Would you consider a separate fund? It's a good question.
Watch this space, John. Watch this space.
Yeah, we can't say anything right here, right
Can't say
now.
anything right now, but we'll have something to say in a few weeks.
Question from Meg, which sounds a little bit like something earlier. I'm with Simplicity, single in my late 50s, and do not wish to use my Kiwisaver for a house deposit. However, I sold my house in Christchurch prior to COVID. I'm struggling to get back in the market in Auckland with this crazy property boom. Would I be eligible? I'm renting in Auckland, and the term of the deposit is my issue. Essentially, I think the short answer, Meg, is no. At this stage, we're only lending to first home buyers that have not owned a property previously. But as I think we've said already, that's open to review in time. But right here, right now, we are just.
Yeah, the general rule is if you're allowed to take your Kiwisaver funds out because you're a first home buyer, then we can lend to you. But if you're not allowed to take your Kiwisaver funds out, we can't. Yeah.
Question from David, what, I presume that's New Zealand time, our unit price actually done? The cutoff is the end of day in each of the different time zones, David, and then all of that information is accumulated on one day, and then the following day the price is struck. They're usually struck mid-morning on the day of striking, but sometimes, depending on sometimes there are issues that mean they get struck a bit closer to lunchtime. But essentially, 2 days after the close of the last close, which is the west coast of the US, is the final close, and then all the values are worked out from there. Logan's got a problem because I've been wanting to open an investment account for my newborn, but the banks won't let me open an account for him as he won't meet in person due to COVID. Is there any way around this in the meantime? I think the simplest thing, Logan, is to send an email to info@simplicity.kiwi and check with our customer services team. They may have a solution. I think it might be an issue.
Certainly open it. We certainly open accounts. We never meet somebody when we open an account. So in theory, we can do that. But that would be an investment account, Logan. If you want to get a bank account with a bank, we're not a bank, and we can't make their policy.
No, but I think he's talking about an investment account, but we require a bank statement in the name of the person.
I see.
Have a go through to customer services, Logan. And info@simplicity.kiwi.
We will try our hardest.
Question from Caroline: how will Kiwisaver compete with rising inflation going forward?
That's for you, Andrew.
Is it? Goodness me.
Well, I can try if you want to.
No.
So, yeah, you go for it.
Inflation is an interesting issue. It's not something many of us have had to deal with for such a long time. If it really got hold, then obviously it is bad for investments. But what happens is the inflation inflates everything, so everything goes up. The question then becomes the real yield. So interest rates, for example, if inflation is going to rise, interest rates have to rise slightly further. And the reason that the central banks will put interest rates up will be because the reason for inflation getting a hold is if growth has got out of hand and people are just paying more for things because they just need them now, rather than the way things are at the moment. Nobody pays more for anything. So Kiwisaver will go up. It'll go up more. It may not do as well in real terms as it's doing at the moment. But as we say, it's the diversification which is the key and the thing which will help most, because as long as you've got your investment spread as widely as possible, there will be winners and losers. As long as you've got more winners than losers, you'll do okay. Was there anything you'd add, Sam?
All good, yeah, very good.
Oh dear, apparently my audio is not so good. Sorry about that. Question from somebody, just opened a simplistic Kiwisaver. What do I need to do to get the government contribution? Provided you are over 18 and you put in $20 a week, the government will put in another $10 for you at the end of the year. So that's basically it. If you're employed, if you're salaried, you'll be getting contributions deducted from your salary, and that will be going into your Kiwisaver once it's open.
So the government has a cut-off date, which is, I've forgotten, Andrew. Do you know what the cut-off date is?
Well, 30th of June is the annual
30th of June.
cycle.
So what they do is they look at the 30th of June, they say, how much have you contributed the year before? And we'll subsidize that for $10. For every $20 you put in, we'll put in $10 up to the maximum government contribution is $521 a year that they'll put in, but that's free money. So yeah, but you have to have put in 1,042 or up to that, right? So let's say you put in $500, the government will give you 250. Let's say you put in $1,000, it'll give you 500, 1,042, 521, and then it stops. It doesn't matter how much more you put in. That's the maximum government contribution, but it arrives in one lump sum at the end of the year, but it reflects all of the money you put in from 30th of June in the previous year.
And so I think we are on our final question, unless I've missed one. And it's apparently from L, not entirely on topic. Why has the New Zealand dollar risen against the US, the euro, and the pound in the last few days? Yeah, I think the reason, L, is that New Zealand is the only country really putting interest rates up deliberately. Interest rates are going up a little bit around the world, but by comparison, New Zealand, the New Zealand markets, New Zealand interest rates are relatively high. And what that tends to mean is that people will be attracted to the currency because they'll be earning more interest sitting in New Zealand dollars than they are in their own currency. So I don't think there's been any specific reason in the last few days that's different, except that, as Sam noted at the beginning of all this, our interest rates over the last few days have risen quite a lot more. When that inflation number came out a few days ago, our interest rates have risen up quite a lot more, and that's probably why we've seen the increase. So we've got two hands up. There's just one question from somebody: if you're over 65, does the employer still match the contribution? They may not. They don't have to. So if we've got,
if the employer wants to, they can, but they're not legally obliged to.
No. So sorry, Amir, if you.
So Amir, if you could bring them on, that would be great.
Keto, you're on mute at the moment.
So, Keto, if you want to ask us a question, you need to go off mute because we can't hear you.
No.
Oh, we're looking for, is that Glynis? Have we got Glynis on? This is like running a really terrible talkback radio show, isn't it? Well, it's not working. Glynis, I think you're on mute there as well. Oh, John is saying, I don't think they can unmute. So Amir, are you aware of whether they can unmute? Amir is our techie guy at the back there. Well, actually, he's our chief technical officer. He's the main man when it comes to technology. So we've got 2 hands up and 2 people on mute. We're just waiting to see.
That's frustrating.
All right, well, I'll tell you what, I don't think that's working either. We've got David up and you're also on mute. So there might be something technically which is not allowing people to unmute themselves. So apologies, folks. Why don't we do it this way? I'll give you my my number is 021 491 547, 021 491 547. If after this finishes, you just want to give me a call, very happy to chat through whatever you'd like to. So I think that brings it to an end. Andrew, thank you very much, mate.
No, thank you. And some great questions. Thank you, everybody. Thank you for the ones that are still sitting there listening. So appreciate it.
If I could just ask one favour of you, if you like what you see, please just talk about us. That means we don't have to spend your money and your fees on advertising. So that would be fantastic. So thanks very much, everyone.